joining us today. My name is Colin Kunau. I'm a tax lead here at Richey May. We also have Jon Sharon, who's a tax partner and the leader of our tax team on the alternative investment side. Today, we're going to be talking about just common questions that we get regarding non-U.S. partners and alternative investment funds, things that we typically see. We'll just kind of jump right into it. So from a fund manager's perspective, I worked with my tax counsel. We did really good throughout the year. We got K1s out on time. Everything went great. But I do have a non-U.S. investor in my fund that received a K1. What obligation do they have with U.S. tax compliance, if any, John?
Yeah, I mean, that's a great question, Colin, and one that often comes up. I'd say, first of all, oftentimes, as you're setting up the fund, it's good to let your tax advisor know we're planning to have non-U.S. investors, whether that's non-U.S. entity you set up yourself or you have other non-U.S. investors. But sometimes that question waits and comes up when we determine or your tax advisor determines that you have a non-U.S. investor and you walk through it. So typically, it depends is really what the answer is. And it depends on what type of income your fund has. There's different types of income that are taxable to non-U.S. investors and other types that are not taxable. And then within the amounts or types that are taxable, there's different types or subtypes within there as well. So kind of high level. And again, it really depends on the strategy. So this could often take a deeper dive and really a strong analysis of what type of income. But let's talk about a typical hedge fund that's just trading mostly U.S. stocks, bonds, maybe some commodities, something along those lines. Typically in that type of fund, your capital gains are going to be treated as sourced to the location of the partner. So what that means is if you're a partner, say let's use Cayman Islands, because we'll talk about Cayman Islands and BVI structuring in a little bit, but let's say that you're a partner in the Cayman Islands and you receive a K1 that has US or capital gains on it. Typically, those are going to be sourced to your location, Cayman Islands. And so you would not owe US tax on it in that case, unless you have other reasons where you may owe US tax. And so that's something you definitely have to consult with your tax advisor and make sure that typically capital gains are included in a trading on your own account safe harbor that the IRS allows for not being taxed in the U.S. Other types of income are, let's say, interest income. Interest income falls under a bucket called FDAP. And if it's U.S. sourced interest income, it may have a taxable impact or withholding requirement. Although a lot of interest income is exempt using what's called the portfolio exemption. And we're not going to get into that really at this point, what that is, but definitely talk to your tax team and determine, is my interest exempt based on the portfolio interest exemption. The other types of income and where the most common FDAP withholding comes into play are U.S. dividends. So let's say Ford or any other U.S. company pays a dividend. That dividend is allocated to a non-U.S. partner. That dividend would then have a withholding requirement associated with it. If it goes to most jurisdictions, unless if there's a treaty, it's 30%. If there's a treaty, there may be a reduced withholding rate. But let's say, for example, using Cayman Islands again, we allocate $100 of U.S. dividends to the Cayman Island partner. There would be a $30 payment due under this FDAP withholding regime. So taking a step back, and then we'll talk about another type of income here shortly, but taking a step back, most capital gains and other types of income, even 475F income and similar types of income are not going to be taxable as they go offshore if the fund meets the trading on your own account or trading on account of the investor safe harbor. But dividends and interest may apply. Certainly, there's so many different examples of times when that could be different, and so it really takes a deep dive. So that's just a high-level general rule to point out. This is a long answer, but getting to the ECI side is the other type of income. ECI is typically income that does not fall into that safe harbor. And so ECI could be things such as let's say you hold a private investment that's an operating partnership in a U.S. company, and it passes through income. Or maybe it's a publicly traded partnership that's in oil and gas or something similar. Generally, income that meets that ECI definition is also going to have a withholding requirement. The fund is going to have do the withholding on the type of income. The withholding rates vary depending on the type of partner, but that's slightly different than the FDAP withholding.
Yeah, perfect. I guess kind of on that topic, I mean, with FDAP and ECI, those do trigger different filing requirements kind of for the fund, and definitely what should be kind of sent to their non-U.S. resident partners. And I guess with that, we'll just pretend it's FDAP, right? There's dividend withholding, there's a 1042 and a 1042S that comes out. A lot of times these names seem similar and they might seem repetitive. So I guess what's kind of the purpose between the 1042 and the 1042S?
Yeah, it's a great question. So FDAP specifically, FDAP is very common in a lot of alternative investment funds. Again, the U.S. source dividends, that comes up quite a bit. So you have that FDAP withholding, the fund makes the payment on behalf of the non-U.S. investor. That 1042S as well as the K1 would get issued to the investor. Generally, the 1042S is going to have a different timing component than the K1, but that would get ultimately issued to the non-U.S. investor. Typically, it stops there. So meaning the non-U.S. investor gets the 1042S and that withholding is made. The non-U.S. investor generally would not have a filing requirement in the U.S. related to that FDAP income. Of course, they need to consult with their tax advisors to confirm, but that's generally the case. And so for the fund's perspective, they need to make the 1042 payment, often what we refer to it as, but really it's a payment on FDAP income. They file the 1042, which is basically a compilation of all of the 1042S's.
Yeah, and I guess kind of on that, if there is a payment due, typically the IRS doesn't like the extension of time to pay. So there's a certain time for that, and then the 1042S can kind of come later, is kind of what you mentioned with the timing difference. I guess kind of on that topic, when there's a payment due, I mean, that's got to come from somewhere, right? Typically, how is this paid, or how do we see it, and how's it reflected on the books? Yeah,
that's a great question as well. So it really depends on how the fund does their 1042 payment. So one method's called the lag method, and another method would just be paying as estimated payments in advance of the income or while the income's received. I don't know that we'll really get into that, but certainly chat with your tax advisors on the payment timing. But typically, the lag method is going to be paid after the K1s are issued, is when that payment's going to be due. And where it comes from is the fund makes that payment on behalf of the non-U.S. investor. So using my example from before, you've got $100 of U.S. dividend income allocated to a non-U.S. investor. The fund withholds $30 on that investor. From a book perspective, that would be treated as a distribution to the non-U.S. investor. So it's not an expense shared by all the partners. It's specifically a distribution to that non-U.S. investor.
Yeah, I think that's a great point. Oftentimes it's easy to see that expense and like, well, this goes to everybody. That's not the case with these payments, because it's only triggered for one specific person or specific individuals, I guess. So I guess on that, once this new non-U.S. partner kind of receives this 1042S, is there any obligation that they have on their end, or does the line kind of end there?
Yeah, so typically the line ends there for a non-U.S. investor. As I mentioned before, they definitely need to consult with their tax advisors, but the line ends there. And I think it's important to point that out, and that it's different from ECI withholding. So I mentioned the ECI withholding earlier. That's done with a different form. And so typically, first of all, that's going to show up on the form K3 as ECI. The FDAP income, there's an FDAP column on part 10 of the Schedule K3 also. So have a look out for those as well, in addition to receiving 1042 or this form for ECI. So ECI, if you have ECI, the fund would withhold on form 8804 and 8805. Similar to the 1042 and 1042S, the 8804 is the compilation of all the 8805s, and the 8805 is what is specifically given to a partner. So let's say that I'm a corporate partner, I receive $100 of US ECI allocation. There would be generally it's at a 21% rate, so we'll use that for this example. There'd be it's at $100. There'd be a $21 withholding payment made on my behalf. It would show up on Form 8805, issued to me as a non-US partner, corporation, and it would be paid by the partnership very similar to the FDAP payment. The difference here is generally a non-US investor that receives ECI income is required to file a US tax return, and they would report and attach the 8805 as a tax credit for their filing. And so it's a little bit different and a little bit more to do for the non-US investor than FDAP income.
Right. Yeah, it just kind of shows how much planning you really should go into these and what type of income you should really consider, so you know what's kind of coming through and what your investors can expect.
Yeah, absolutely. I think, and Colin, just on that too, is one of the things that I think sometimes happens is funds will invest in PTPs, for example, or a small private deal, and then later say, oh, I didn't realize that this was going to cause a potential tax filing requirement for my non-US investors. And so that can pop up, and that can be a big deal.
Absolutely. I guess getting into that, as we kind of talk about what investments are coming through, kind of maybe what the future plan is to grow your fund. Since we've talked about some of the basics of withholding, I guess, of course, we want to lessen the burden on these non-US individuals and entities. I guess whenever you're a new fund manager or you're looking to start a new fund, what's something important that they can kind of look to help alleviate the burden that these foreign investors might be looking towards?
Yeah, so it's a great question too. A lot of it's structuring. There's various different types of structuring that funds can do. We're going to get into three main types of structuring. There's so many different types of structures, but just kind of general ways of looking at it. So one is if you've got a standalone fund, so meaning, let's say it's a Delaware limited partnership, it could be a Delaware LLC, or it could be among a number of other types of structures there. But if it's a Delaware pass-through entity, generally what you're going to have is if you have a non-US investor, they're going to invest directly, and then all those tax attributes we discussed earlier will go directly to them. On the other hand, you could go with either a mini master or a master feeder structure. And so let's talk about those a little bit more. A mini master is a US entity that has a BVI or Cayman or potentially other jurisdictions, but BVI and Cayman are pretty common, that has a blocker entity that invests in the US Delaware partnership. And so your non-US investors would invest through that. And that entity would be treated as a corporation for US tax purposes. And so where that comes into play is if a non-US investor invests into the foreign blocker, then the US entity, let's say that it produces ECI and FDAP. The FDAP withholding, so first of all, the US partnership would issue a K1 to the foreign blocker. And since the foreign blocker is a corp, it kind of stops there. For the foreign blocker, if it's receiving FDAP withholding, well, it reduces the return at the foreign blocker level, which indirectly affects the non-US partner. If it's ECI income, then the foreign blocker would have the filing requirement for the ECI. And so it would still pay the tax, but it would basically block the non-US investor from themselves having to file a US tax return. And so where that's beneficial is it helps keep your non-US investor from being receiving a K1. And so a lot of non-US investors don't like to have their information provided to the IRS, even if there's no tax filing obligation. And so it can help keep them anonymous from the IRS in that sense, but it also blocks any unwanted tax attributes that may flow through and that may cause the non-US investor to have to file something with the US. And so that's kind of a mini master. That's US partnership with a foreign blocker. A master feeder is a little bit bigger than that, where you may have a Cayman or BVI master fund that's treated as a partnership, and it would have two investors. One investor would be the U.S. Delaware partnership for all of your U.S. investors, and the other entity would be the foreign blocker, similar to what I described before. The difference here is, do you need a foreign master fund? And there might be legal reasons for that. There might be something related to making a certain type of investment. You may have an investor that prefers a full master feeder than a mini master. So there's various reasons to have that. Many times the mini master will accomplish what you're looking for. Sometimes you might need a full master feeder. And so certainly talk with your tax team as well as legal counsel and investor preference on that. And while we're on the topic, I know we're talking mainly non-US investors, but I'd be remiss if I didn't bring in, how does it affect US tax exempts? And so many have heard of blocking UBTI for US tax exempt. So in either of these scenarios, mini master or master feeder, if you're going to have leverage in your fund, if you're going to produce UBTI, which oftentimes ECI is UBTI, so you could have ECI that's not, and you could also have UBTI from income that's not ECI. But let's say you have UBTI, it'll block that UBTI from your non-US your tax exempt investors if they invest along with the non-US investors in the foreign Cayman or BVI blocker.
While we're talking about mini masters and master funds, is it possible to do a foreign master with a foreign feeder?
Yeah, and so you're saying without a U.S. feeder, it is definitely possible. It's a mini master where you have a foreign master fund and a foreign feeder. That, again, speaking back to before, where maybe you have a need to have a foreign master fund for legal reasons, or to invest in certain types of investments that maybe you need a non-US master fund for. The reason that you generally still want to have a US feeder is for your US partners. So typically, a US feeder can file a lot of the non-US or foreign master fund forms for owning a foreign partnership. And so that's Form 8865, as well as potentially others, all depending on the facts and circumstances. And so if a US investor directly invests in the master fund, they'd be responsible for filing some of those forms. And those forms, it's not going to really change the tax impact, but it does increase their filing burden. And so a lot of times having the US feeder helps shield them from various foreign forms or reportings that they might otherwise need to do.
Right. Yeah. So I guess kind of on that topic, I mean, it kind of comes down to choice of entity, right? From our discussions, I mean, it kind of sounds like the master feeder is kind of the Cadillac of structures, right? You can cover your bases with your tax exempt, your non-US investors, and there's certain elections that might be able to help let your entity be a little more flexible. So I guess with that, it does sound a little expensive. Doesn't sound cheap to get that structure going. So what are some benefits or cost benefits that you should kind of look at if you're a fund manager?
Yeah, so that's a great question. And certainly I'd chat with legal in all of this, right? There's so many things to consider on the legal side. I'd also make sure you're really understanding what type of income you're going to get. If you're setting up a master feeder structure to invest in solely US operating partnerships, you probably don't want to have a foreign blocker. Again, that's probably a topic for another day, but there's other types of blockers and other types of ways to go about that. So there's a lot of planning that goes into this. But if you're specifically looking at the cost benefit, it really depends. A lot of it's capital raising, right? If you're looking for maybe you have one non-US investor that's coming in and they want you to set up a foreign blocker. Well, basically, what's that non-US investor coming in at? How much is that check, right? Is it worth the cost of setting that up for that non-US investor? And maybe the other question is, are you targeting other non-US investors? If it's one small non-US investor, maybe your answer is, hey, we currently don't have enough non-US investors to where we want to set up a full foreign blocker. And so you have them come in to the master fund, or if it's standalone entity, you have them come into the US Delaware partnership. But then again, as mentioned before, if you have tax exempts, a lot of tax exempts like going into the offshore blocker feeders, because it can block the UBTI if any does get created, whether it's planned UBTI or UBTI that you don't intend on creating. And so that type of setup could be beneficial if you say, okay, well, I only have one non-US investor. It's not very big, but I do have a lot of tax exempt investors. Maybe setting up that blocker makes sense. So really, a lot of it is just deciding what's your goal, what are you trying to accomplish, and does it make sense for setting up? And I think the other thing to consider too is you don't have to necessarily have that all set up day one. Let's say day one, you're targeting US investors, and then as you go along, you have a bunch of capital sitting on the sidelines from tax exempt and non-US investors, and you say, oh, I want to add them. Well, you can always add a blocker later, and you can always adjust the structure. In fact, a standalone fund could convert into a mini master, it could convert into a master feeder. It could add other types of structuring, but all just kind of depending on what your need is at that time. And all of it's generally doable. But I would certainly suggest, if you're looking at those options, is consult with your tax advisors, consult with legal counsel, consult with your administrators as well, and really just look at it from all angles to determine what's it going to cost, what does it look like, and what benefits do you get.
Right. I think it's a great point to bring up the kind of the evolution of the fund, because there are sometimes maybe it's not planned, kind of what we talked about. Sometimes those PTP investments start getting involved, and it does start generating ECI. It's like, oh, kind of need to change my strategy, right? So yeah, making those adjustments as you go along, and it's great for managers to kind of know that's an option. I feel like it's a good place to maybe bring this up, but since we're talking about blockers and Cayman entities, BVI entities, a lot of this comes off as possible tax avoidance, but that's typically not the case, right?
It's a common misconception that these entities, these foreign entities, are set up to avoid tax. And really, that's not what it is. They're set up to block tax attributes and essentially pay the tax themselves. So again, as we talked about earlier with ECI or FDAP income going offshore, that income's still taxed, right? But it's taxed in a way that blocks it from a non-US investor having to be subject to that tax directly. And again, there's different filing requirements and things that come along with it, but it's nice to be able to block that from them and then have a blocker pay it on their behalf, so they don't have to file or have direct tax connection with the IRS. Even in the UBTI scenario, that UBTI blocking, you may think, oh, well, it's avoiding them having to pay UBTI tax. Now, I will say the UBTI, if you create a bunch of UBTI in the fund, it may not be a direct correlation for blocking versus taxes paid, but if you do have FDAP income or other types of income, that tax will be due related to that type of income. So there may be some tax savings on blocking the UBTI, but there may also, on the other hand, be taxes paid on certain types of income that gets allocated to the blocker. So again, these structures are really not about tax avoidance or trying to not pay taxes. It's mostly about, it's more about trying to help structure it to protect your investors from having that U.S. tax connection.
Right. Yeah. And based on kind of how your fund's set up and the investors that are coming in, it might make your fund a little bit more appealing to make sure maybe they have some protection, or at least alleviate some of that burden.
Exactly, because some investors expect these structures if they're going to put money in, right? They're looking for these types of structures to be able to have their money in a spot where they can be protected from these attributes. And a lot of these structures are very common throughout the fund industry.
All right. Well, thank you, John, for your insight today. We talked a lot about withholding and structuring. It really comes down to not one size fits all. You definitely need to consult with your tax team and your legal counsel. If any questions come up, definitely feel free to reach out to any of our team at Richey May. We'd be happy to help and advise in any way that we can. Thank you for watching, and have a great day.